There's a saying that amateurs book profits and professionals book losses. Successful investing is not just about how smart you are, but how you behave. I don't think you need to check your portfolio more than 4 times a year, once a quarter. It's fine if you miss out on a few options here and there, rather than just doing it knee-jerk out of FOMO.
Hello everyone, welcome to Money Skills by Scripbox. I'm your host Shikha and we have Varun Girilal here, who's managing partner of Scripbox. Varun has been into this wealth management industry from last 20 years and has been an experience of managing the investors and their behaviors through the ups and downs of the financial markets. And I really need to mention one more thing about Varun, which is an interesting fact that Varun has been a former Ranji player and has played cricket professionally. Varun, I'm really looking forward to have an interesting conversation on the topic, which is mind of a measured investor. I found it really fascinating. What do you really mean by it? How do you define mind of a measured investor?
So, when you think about finance, people usually link it with maths, formulas. They think it's something done by very smart people. My own experience over the last 2 decades has got me to realize that successful investing is not just about how smart you are, but how you behave. There are some simple approaches that one can use which can help you develop what I call the mind of a measured investor. So a really good example I like to quote is from this bestseller book of this well-known author called Morgan Housel, who has influenced and inspired a lot of the work that I get to do. So in his book, The Psychology of Money, there is this example of this simple person. I think his name was Ronald James, a janitor, petrol gas attendant. And Ronald James in his will left behind like 16 crores for his kids, some 48 crores for his local library and charity. And on the other end of the spectrum, you have this investment banker, Richard, who goes bankrupt. So the learning here is, and I have practically also seen that a lot of average people, by just following some simple approaches, are able to achieve financial freedom.
Wow, that's an interesting example you've given, Varun. Do you think we all can get rich like that janitor? I mean, what do you think what he did different?
So it was a very simple process of consistently investing in solid investments over decades. I've seen hundreds and thousands of people like you achieve it just by following the simple process of being consistent. We'll share some of those specific approaches as we go on in the conversation. And a very important point I would like to make there is, people sometimes think that being financially aware or savvy is about being like Scrooge. No, on the contrary, it's about having fun, doing things with a plan. When you spend and indulge, I mean, we all work for a living, but we live for our passion. So when you spend, you do it with clear clarity, with a clear budget in mind.
Yeah, in fact, as you mentioned, the question which I was mentioning, how do you connect cricket and finance?
Actually, I would say cricket is a microsome of life, and a lot of life is about money and investing. And there's just so much interconnectedness. In fact, my introduction to finance happened because of cricket. So when in India, as you all know, the Indian Sports Board is a rich body, and from a very young age you start earning money. I mean, when I was playing under 16s, I used to get a little bit of money, not the big money like these IPL players, like a few thousand. And that's what sparked me to start investing. So I started investing at a young age, and with smaller amounts of money I got my bouncers, googlies, got bowled, run out. And by the time I started earning, I had already been through a little bit of market cycle and was able to become a little more informed and mindful as an investor. So a lot of parallels between cricket and investing.
Okay, that's an interesting connect, I would say. So, Varun, if you take the cricket analogy for someone who is in his 30s, should you play a test cricket with your investments or T20?
You need test cricket and T20. So let me bring in analogies of some of our loved players, our very own Tala, MS Dhoni. And today he's like an elderly mentor for all the young emerging cricketers in India, and relate him more towards long-term, balanced, composed investing. And our aggressive Rishabh Pant, who plays those audacious reverse sweeps, as what we would call the aggressive kind of investing. I would say you need a mix of both, because in your 30s, you have now spent around 8-10 years in corporate. If you have been careful, you could be able to save a lot more. The first thing I would say is get in before you go in for your offense and playing the attacking shots. Get your defense in place. Get your standalone medical insurance in place over and above what you have from your corporate. Because, hey, from COVID, we learned that sometimes you could be out of your corporate job. So you need to have a backup standalone Mediclaim. Get a term life insurance. Don't mix your insurance with investments. Get a pure protection term life insurance policy if you have people depending on you. And in your 30s, you would tend to get lower premiums. And then try and see if you can get your savings every month up to anywhere in the range of 20 to 40%. The higher, the better, of your regular income. In terms of your allocation of assets, I would say anywhere in the range of 50 to 70 towards aggressive equity-based mutual funds, and the remaining 30 to 50%, depending on your risk profile, the way you deal with volatility and uncertainty. I would say so between 50 to 70% in aggressive investments, and anywhere between 30 to 50% in the steadier options. That would be a good balance. Personalize it to your context. Okay. So you need both T20 as well as test cricket.
So you really had a long career in the wealth management industry. What do you think? What are the common behavioral traps or the missteps which are happening, and what one can do to protect against these pitfalls?
So let me talk about some of the key pitfalls, which I feel if you get these 4 or 5 big ones in place, a lot becomes automatic. I mean, financial wellness becomes automatic for you. So we are in election season. I think a very good one would be, a good one to start would be what I call recency bias. So one of the big challenges we face as human beings, and there's scientific research on this, is we are all short-term driven as humans. To be able to think long-term is not something which is natural for most of us. So recency bias is a tendency to get swayed by a recent good or bad performance of an investment. For example, if the markets have not been doing badly, we tend to think, hey, things are not good over here, let's stay away. We'll get back in when things stabilize. Or when, for example, let's say gold has had a good run for a few years, you'll hear people saying that, hey, you can't go wrong in gold, and people tend to get allocated to an asset after it's already gone through a really good cycle. So if I think in terms of some examples, I remember during 2003 to 2010, there was a super cycle in real estate across the world. It's like you just invested anywhere in real estate, you made a killing. Now, what I observed happening with customers is those who made money getting in early, their next investments, which happened between 2010 to 13, happened at a really high level. And then we had the global financial crisis, which happened, and it all averaged out. So you made great returns between 2003 to 2008, and then from 2008 to 18, it plateaued, went flat, and it just kind of averaged out. But people were led into taking bigger bets, and some people even took leverage. So what has happened in the recent past can tend to influence you. Another simple common example is, let's just do a Google search on the top 10 best mutual funds. So In fact, there's research on this also, that what has been the best performing in the recent past, it's quite likely that it may plateau out in the coming years, because you tend to come in at a higher valuation. So, markets are discounting machines. They move counterintuitively. So before the actual good news or bad news happens, the markets have already gone up or down. And that's what creates a challenge for a common investor. So if something has done badly recently, maybe there may be an opportunity if the fundamentals are strong. If something has done really well recently, you need to do a little more due diligence on, are you getting in with enough margin of safety, or are you getting in when there's too much of froth?
Yeah, I'm sure that you have faced the clients in that period when 2008, the global financial crisis had happened, when COVID had happened. I mean, what would, how did you handle the investors that time?
So there's this nice line I've heard. I think it's attributed to that famous boxer Mike Tyson. Everybody has a plan till you get punched in the face. And these huge punches you get are these disruptive events which happen in hindsight always, like the global financial crisis in 2008, or a few years back, the COVID crisis that a lot of us went through. So one thing that has helped me is to maintain a kind of a investment journal. And I do write down what I went through in terms of client situations and market situations. So every time I read it, the memories come back very vividly. But there's always a common theme that, is the world going to end? Should I just sell and get back in when everything improves? Let me reflect back on what worked and what didn't. And I think one great learning for me from all of this is, rather, like, nobody really knows what's going to happen in future. Like, in a world where there's just so much of time spent on forecasting, market pundits, predictions, I think it makes more sense rather to, what I would say, invest in prediction, invest in preparedness. So who were the people, what were the actions which worked during these really disruptive periods? People who did well. So if they had a plan that we have allocated to this investment and we are going to stay put for the next 5, 8, 10 or 12 years, they stuck to it. If they were investing every month, let's say through a SIP, a systematic investment plan, they continued with the investments. A few of them even topped it up. So what seems like the world is going to end in the near term, in a few quarters settles down. That's what market history shows us. I think one thing which really helps when I talk about preparedness, I think it's a great practice to just write, if this were to happen, let's say, if markets were to fall by 30%, these are the 3 action points I will ensure I take. Okay. Because once you have written it down and you can refer to it, and you also have the support of a good wealth management firm or someone who's helping you with your investments, you have a better chance of sticking to the plan. Right. So writing down, having access to a good wealth management firm or a good advisor can make a huge difference in helping you deal with these disruptive market events. After recency bias, the next big one is loss aversion. So, as human beings, losses hurt much more than gains of an equivalent amount. You make a 20% return from an investment, but you make 5% loss. The 5% loss hurts much more. Now, this can be something which can be really counterproductive when it comes to managing your investments. If I go back to market history, I remember in 2008, there was a lot of clamor around investing in infrastructure funds. And a lot of investor funds started chasing infrastructure funds. When the global financial crisis hit, markets fell 50-60%. So almost any fund you had your money in, it fell at that level between 50 to 70%. However, certain hot themes like infrastructure funds took a lot longer to get back. Whereas people who had their money in what I would call diversified equity funds, which invest in multiple sectors, sometimes they can seem like boring, but they work brilliantly over the long run. People who either had the investments in these diversified funds or made the switch from an infrastructure fund to a diversified fund recovered much, much faster than someone who couldn't book that loss. So there's a saying that amateurs book profits and professionals book losses. In fact, a professional or a measured investor will look at that act of shifting from a loss to another investment just as a shift. So I had 100 rupees, which has now come down to 80 or 50. I need to get back to 100. Am I best off sticking to this or do I need to switch it?
Yeah.
Now, this is a very thoughtful, mindful decision to be done. Sometimes you'll also want to just take action and just pull the trigger. So you have to study the fundamentals. If the fundamentals are strong, you stay put. If the fundamentals need to be relooked at, book the losses, move on. Another typical example I can think of is sometimes people often get pushed into insurance as an investment option. And then when they meet a advisor and the advisor shows them the opportunity cost of continuing with it, you often have to book a loss and shift it into a more efficient investment. People struggle with doing it. So as a result, over the long run, the money gets invested in a inefficient manner and you lose out big in terms of investment returns. So recency bias, loss aversion. Another important one is confirmation bias. So confirmation bias is about being prejudiced to pre-existing beliefs you have. And from an Indian context, a good example I can think of is if you look at most of our parents, a large part of their returns and net worth came from investing in traditional investments like real estate or gold, right? So typically every parent, and it's not just that they have had a good past experience with real estate, but also, we all tend to have that sense of security when we have a house. So at very often, much earlier than what is required, people tend to get allocated to a home loan EMI or higher than required allocation to real estate at a higher valuation just because it worked for your parents. And even as individuals, just like we tend to have our favorite actors, our favorite cricketers, we tend to believe that, hey, if this is an investment from a Tata, Reliance, Birla, it can't go wrong. So holding to our preconceived notions without objectively looking at the data and evidence can hold us back from successful investments. The next one is something which is, I think, amplified in this day of social media influencers, FOMO. So there is a thing that should we be called FOMO sapiens or Homo sapiens? So fear of missing out is something that keeps on playing out again and again. I can go back to 2002 when the telecom industry was just exploding in India. So mobile phone companies, every average Indian could afford a mobile phone, and mobile phone consumers were growing by exponentially. Now, interestingly, while the industry grew, the customers got a lot of benefits. Did all telecom companies really work out as a great investment option? I mean, we have all heard about what Vodafone is going through. There's companies like Reliance Communications, which have even have had to shut down operations. And you have a company like Bharti, which has kind of been an outlier. But again, when you look at returns over 20 years, it's not been like a real exponential return. It's got averaged out. I see a similar thing happening with electric vehicles, AI, ML, where there's a lot of FOMO getting created around investing. It's an emotion. So you have to make sure you're not doing anything out of FOMO. If you're doing it, you're doing it with a plan, you have thought through. And one good practical way of dealing with FOMO is to just delay what you're planning to do. Investing is not a sprint, it's a marathon. It's about thinking of decades. There's always going to be options. It's fine if you miss out on a few options here and there rather than just doing it knee jerk out of FOMO. The other one is checking your portfolio frequently. So, my suggestion is if you have really thought through your plan and you have the support of a good wealth management company or a advisor, I don't think you need to check your portfolio more than 4 times a year, once a quarter. And why? See, markets, the essential nature of markets are they fluctuate. So if you are looking at your portfolio every day, your mind is just going to keep fluctuating. You look at it 4 times in a year, you have a less of a problem to deal with. And if you have really done it in a planned manner, that's what you need to do. And if you have a good wealth management firm or an advisor, when you really need to do something beyond those 4 times, they will get in touch with you and get it followed up. So before allocating, make a good plan and then stick to it. Don't frequently check your portfolio. It becomes counterproductive.
So do you think that social media plays a role in, when people have this FOMO and people want this instant gratification? They have that, I would say, that obligation to look at their portfolio every day. The new generation, they just want to do the trading and they just want to earn instant profits and everything. What is your suggestion to them? I mean, how do they avoid getting impacted by the social media?
I think social media gets FOMO on steroids. And there's been this huge proliferation of what you call finfluencers, some of them doing a great job, some of them under the scrutiny of SEBI. And SEBI's, in fact, had floated a consultation paper on getting better regulation into this. I think it's a place you have to be really careful. All of us struggle with it. So it tends to be a lot about sensationalism. So there's a difference between creating awareness and inducing people to do things in the short term out of FOMO. Yeah. I think social media is something that gets this on steroids. A good way to deal with it is to first check whether that person on social media is someone who's regulated, what has been their track record over the years, not just 1 or 3 years. I would say they should have at least an 8 to 10 year journey in the markets. Social media does not give you a deep and often doesn't give you a deep and thoughtful explanation. So it's a good way to get that initial impetus, the initial spark. But then you have to do a little more thoughtful and deep work. So I know of thoughtful investors who are not even on social media because the work that they need to do to become a thoughtful investor is no way connected with social media. So it's definitely something to take care of, and something which can really drive a lot of this instant gratification, FOMO based kind of investing. I'm happy that it's good to see the regulator really bring in some measures to get it into the right direction. I think they want it to be more about education and awareness rather than inducement.
Okay. So, what do you think when should one stop?
So, Shikha, in social media, there's one very important piece. So you tend to get that feeling that, hey, everybody is succeeding at investing. I'm the only one who's not doing enough for my money and investing. Yeah. And I can tell you that what gets out there is typically mainly success stories. Yeah. That's only 10%. The reality is majority of people are facing challenges and struggling. So just like when you see in terms of travel and vacations. Everybody's having a good time traveling to exotic places. In money and finance, it creates a perception that, hey, everybody else is doing smarter stuff and you're the one who's getting left behind. So it's something you have to be mindful about and careful.
Right. Yeah. So that's where my next question is. I've heard the term called money dysmorphia, which means that, you have enough, but you feel that you don't have. Other people feel that you have enough money, but you yourself don't feel that I have enough to spend. So, what do you think? What does that mean? And where can one think that, this is enough for me? How much is enough, basically?
I think over here, the personal in personal finance is really important. That enough should not be somebody else's numbers, because each of us have a unique context. Now, you just take the example of retirement, and there are these numbers like let's say you need an annual income of, I'm just taking an example, of 12 lakhs, a lakh a month. So people say you need at least 25 to 30 times that amount. So roughly 3.6 crores as a corpus to be retirement ready. I would say that even the term retirement, it's an outdated term, more connected with the industrial age. What I genuinely see happening with clients today is people have post-corporate lives. So they are doing some consulting work 3-4 days a week. They still have some alternate streams coming in. So it is different mix and match for different people. And also depending on your life stage. For example, for someone starting your job, your first thing is to create an emergency fund. How do I create at least 3 to 6 months of emergency fund? Then it moves to, can I build and save 1 to 2 years of cash flow so that if I want to take a break, upskill myself, I have a corpus in place. So how much is enough is a personal answer. But I think what would be universal in all the answers would be, there are two ways you can do your investments. One is out of a feeling of lack. I don't have enough, being paranoid about. I think that brings in too much of stress. In my own observation, the people who are happy, and finally, everything we do has to be around being peaceful and happy. What I have observed is those who invest out of, I would say, a sense of confidence, abundance, and a planned approach. They are the ones who tend to be much more happier. That, hey, I'm saving this money, and by saving this money, I'm getting an extra piece of freedom for myself. And they just keep doing that consistently. So another one could be, another universal one I would say is ensuring you have your emergency fund in place. And then depending on your life stage, whether you're looking to get retirement ready, a certain multiple of your annual income. So if you're like in your 40s or 50s, I would say anywhere between 15 to 25 times your annual income requirement. I think that's a good range to have. Okay. The more the better.
So we should have a financial plan in place and go as per.
Yeah, I think the first one would be to just a good example I like to use when I get to do workshops at corporates is I talk to people and ask them, especially those who have been 3 to 5 years, I ask them about the Employee Provident Fund, their EPF. And I ask them, have you checked the last balance that you have? And people realize that, hey, it's a nice lump sum. So I try to nudge them to look at the principles that were at play there. So one was, it was not, I'm going to save or invest what is left after spending, because we all know that never happens. So they got that 100 rupees salary, and automatically there was a deduction happening into their EPF. And because it was locked in, the money was growing and compounding. And then suddenly at the end of 3 to 5 years, they have got a nice little corpus. And to get to your enough, you have to get this kind of an automation in place. Ensure that amount is going to the right kind of investment. And in this regard, my recommendation always is a mutual fund, a diversified mutual fund if you're looking at long-term growth, a diversified equity mutual fund if you're looking at long-term growth, because it's a well-regulated product, and there's now enough data in India that over 10, 20 years, you have a good probability of beating inflation if you stay put in it for the long run. But yeah, make sure you choose it through a good wealth management firm or an advisor.
Nice insights we have got, Varun. Let's take something taza and fresh.
Okay.
We had this recent market volatility when the election results were there on declared on June 4th, 2024, after the exit polls and the election results. What do you think, like the markets went through a roller coaster ride during that short time of frame? Can you just take us through your experience of managing clients through that period?
So, Shikha, this is fresh off the oven. So there's that saying that it's definitely election time. If you see stockbrokers giving predictions on the number of election seats and politicians giving predictions about market levels. In fact, we had a nice fun little bet within our team on what is going to be the outcome, what's the number of seats the NDA or Congress is going to win. And we were all just far away from the final result, as were the exit polls. So here is again proof that, hey, risk is what happens when everything you've planned for, like something beyond what probabilities you've planned for happens. So it was a classic example that it's really, really very difficult to predict. But I think what worked at that time, so again, typically when these kind of situations happen, there's those bunch of doomsday messages, videos which come in, and with clients who are new to investing, that tendency of, do I sell now, let me come back in when things stabilize. We have to go through that whole period again. So here again, I think for a firm like ours, given that the senior leaders have gone through different market cycles, we have put in place plans to help guide investors through this. And the key to it is to stick to the plan. I think another good learning from that was, if you see, there were a lot of hot sectors, around this Atmanirbhar Bharat, PSU, infrastructure, capital goods, railways. So a lot of people were getting into this sector-specific shares or funds. And what I saw was, when the correction happened, the sector-specific hot ideas took a lot longer to recover than someone who was just in a balanced, diversified equity fund. If you were in a diversified equity fund, in most cases, you recovered very quickly. So key is to stick to the plan when these kind of situations happen. And you have a better chance of sticking to it if you write down that if this happens, this is what I'm going to do. Yeah. And you have the support of a good wealth advisor or a wealth manager or a firm.
Okay. Varun, I've been listening to this term called VUCA, which is the volatility, uncertainty, complexity, and the ambiguity of the markets. If the world and the financial markets are being like that, does the planning help? I mean, is there any use of the planning ahead?
So we get to hear this a lot, that, hey, what's the use of planning when everything is just so volatile and uncertain, complex and ambiguous? And it brings back memories of our childhood ant and grasshopper story. I think there is huge power in making a plan. And what is that? Planning gives you direction. Planning helps you know the boundaries within which you can play. Planning gives you margin of safety. Planning enables you to do what-if scenarios. For example, during COVID, someone who had a planned approach would have had liquid assets, emergency funds in place, would not have been high on their loans, this person had a lot more confidence to deal with the situation than someone who was just randomly going without a plan. So, ultimately, all investing is about probability. And your probability will increase manyfold if you have a planned approach. So, there is huge power in having a plan. Try and keep it as simple as you can.
Okay. Nice one, Varun. Now, good insights. Just to summarize, can you give a simple framework to our viewers who can just use it to navigate the market volatility as the measured investor?
Yeah. So, if I were to try and simplify it, put a framework, I think first important behavioral change would be to first be an investor before you spend. So like the EPF example, block out where you're going to invest and how much you're going to invest from your cash flows. Try and do that on a regular basis. And here I find SIPs, and I call them not just systematic investment plans, I call them your subse important plan. Because using that example of, we took that example from of Ronald, just a very common person became a multi-crorepati just by investing every month consistently over decades, right? First, make yourself an investor. Have a plan in place where that investment is going to go. So what we call an asset allocation based approach. Typically, I tell people that, hey, anything where you're looking at growth, try to keep at least, if possible, a 10-year kind of horizon, because that's what data also shows, that if you're given 10, 12 years, if you put money in, let's say, an equity-based mutual fund, you have a much better chance of getting good returns. So first be a investor before being a spender. Make it automatic. Have an asset allocation in place. Link it to a goal. Don't check your portfolio frequently. 3-4 times in a year is good. And keep investing into developing your becoming aware of biases and learning more about how to deal with them. That's it. So just, I would say all mindful and successful investors, they follow an approach which is simple, systematic, and long-term in its approach. And there's huge power in it. And that's something I would wish for every investor.
Good one, Varun. I have a last question for you now. Do you think you are a measured investor?
So I've had a lot of my punches, and I've lost money, gained money. But as I mentioned, the good part was I started early with smaller amounts of capital. And then when the larger money came in, I had already become a little more seasoned. So yeah, I do believe that on the whole, I'm a much more measured investor. I have buckets in place for my long-term money, for my fund money, and I do share proactively what has worked and not worked with near and dear ones, and with clients and with team members. So yeah, I do believe that I can, basis how my investments have done over the last 15, 20 years, I think I have now kind of reached that level. But this is a space where you're a lifelong student and you're always learning. And every now and then the markets will give you a new learning.
Thank you for coming over, Varun. And it was a wonderful session, a lot of learning, and hope to keep learning from you in future. That brings us to the end of this episode. Thanks to Varun for joining us. If you have any questions, please leave them in the comments below. We hope you enjoyed this new episode, and if you did, please like, share, and subscribe. See you next week for a new episode.